Okay, well, welcome. Greetings. My name is Peter Treseder. I'm an education manager at AustralianSuper. And before I begin, I'd like to acknowledge the traditional owners of the lands that we meet on. And I'd like to pay my respects to elders past, present, and emerging. I'm an education manager at AustralianSuper. I spend my life out and about talking to people about how superannuation works, going to workplaces. Now, since the COVID invasion, I've been doing sessions about education virtually in this sort of forum. And today's session is about investments. Now, I know a little bit about investments, but I don't know as much about them as my guest today, Sam Weaner. Now, Sam's been with the fund for a little bit of time, but he is an expert in all things investments, far more knowledgeable than me. So how we're going to run the session today is I've got a few questions I want to ask Sam, and he's going to respond to them and expand on the topics that what we find most people ask about when it comes to their superannuation, the economy, where things are going. So I might get Sam to drag out his crystal ball at some stage, and he'll also put on his hindsight glasses as well to sort of see what has happened in the past. Not that past performance guarantees future performance. So welcome, Sam. I'll pass over to you.
Excellent. Thank you, Peter. It's great to be here to share a little bit of the insights of the current parts of the economy, as well as how AustralianSuper is positioning the portfolio and our investment options. So when I look at my history in the markets, I've been in the markets for over 20 years, and there's been many ups and downs over that. And I've enjoyed seeing how the context of history and how assets interact over time to market events. So to start off, provide a reminder that this is general advice only and does not take into account your personal objectives, situations, or needs. We do welcome you to visit AustralianSuper's investment options online or even call one of our investment representatives.
So, Sam, we talk about AustralianSuper as a large super fund. We're the biggest fund in the country. What does the growth of AustralianSuper, which has been remarkable over the last 10, 15 years since the fund's been around, how does that growth work to benefit members?
Sure. So that's an important part of it, is that we do have a sizable amount of assets under management, and these are member assets. So we realize that we have a fiduciary responsibility to help members' assets grow over time. And the biggest part of it is the growth that we've seen it's a mixture of strong member cash flow as well as investment performance. The key benefit of this is the growth of assets opens the door to many new investment opportunities, especially in unlisted assets like property and infrastructure. These assets are a little bit more specialized and take a lot more capital and resources to invest in. So being a large super fund enables us to invest in these assets to enhance member returns over time. A few examples would be things like the King's Cross estate redevelopment project in London, as well as local projects of infrastructure with the Queensland motorways, as well as investments like Ausgrid. So these enable us to invest in the Australian economy as well as enhance returns for the portfolio. So when we look at our size, that us as individual members may only have 20, 30, maybe $50,000 in our accounts, but it enables us to invest like we're a billionaire.
So AustralianSuper has a lot of strength through cash flow. So the amount or the net cash flow coming into the fund, that's the money coming in as opposed to the money going out. Recently, with COVID and the financial situation to put some people in, the government announced a temporary early release of superannuation. How has that affected AustralianSuper, and sort of what numbers did AustralianSuper see?
Sure. So it's definitely helping members with early release has been an important part of the last 7 months. And we want to be here for members because these assets are member assets and we want to be able to help them. And when we look at it, your super is a long-term investment, hopefully to help support your retirement income needs. However, people that are in hardship now, we definitely want to support. So when we look at the last 7 months, we've paid out about $4.7 billion in early release payments to members. And even though that sounds like a very large number, with total asset size of $189 billion, it is a relatively small amount. So our investment team has been very focused on ensuring that there is liquidity in the portfolio to meet these member payments and to ensure that we can help investors in their time of need. One thing we would promote here is that with Super's primary goal of being a retirement income product, that we want to make sure that members have enough income in the long-term needs. So if a member does take out $20,000 today, this could have a significant impact to their savings in the long run. It could even reduce their savings by $60,000 when they get to retirement.
Yeah, so it's a matter of balancing the what you need now for what you need in the future. So if people have taken money out to meet short-term needs, I suppose it's important they do get that back into super at some stage. Now, looking at the last 12 months, I suppose we've had an ups and downs sort of year. We had good growth, then COVID, and then recovery. Can you add a little bit more of what has happened over those last 12 months?
Definitely, it is definitely been a roller coaster year. When we look at it, we look at 3 phases of the year. That first phase being the growth up to the 20th of February, then the downturn during the height of the COVID downturn, and then recovery since then. In this chart, it shows the performance of the balanced option, where a large part of our members invest. That is the orange line. We also have the Australian market, which is the yellow line, as well as international shares, which is in gray. So we see at the beginning of the year, there were many hurdles that we faced with thinking of the China-US relations, as well as even the bushfires that occurred in Australia did hinder returns in the markets a bit. Now, we did see that there were many headwinds in the economy, that global growth was slowing down. However, there was plenty of economic stimulus from governments and central banks to help support this, which drove the equity markets to all-time highs in the 20th of February. What we did not anticipate is the economic shutdown. So that economic shutdown between the 20th of February and the 23rd of March, markets lost over 30% during that time period. Now, what turned that around was when governments put in fiscal stimulus, as well as central banks cut interest rates to help add liquidity to the markets. So what they were eager to do is to offset the potential of a credit crisis or a financial crisis on the back of a government shutdown. So since then, we have seen the equity markets recover quite substantially. However, as you can see with the jagged lines, has been very volatile over that time period. And that's where the markets have been balancing between the prospects of the economy reopening, the additional fiscal and economic stimulus, where we saw the US and Australia provide stimulus of over 10% of GDP, which provided direct payments to the households as well as businesses, which largely offset a lot of the loss of income to the downturn. So these aspects helped the markets recover over that time period. And we just saw announced today in the US that there's been more headway to a vaccine, which has definitely promoted the markets to go higher. So as we have more prospects of the economy reopening, it'll really help out share prices and valuations. But what we're really clear at here is, in order to have a true recovery of the economy, we do need an eradication of the virus, either in conjunction with the development of a vaccine or other methods to help us truly get out of the current economic slump.
So we see in the chart there that the market dropped significantly. I think we've seen drops in the market like that. I think what surprised most people was the swiftness of the market. I mean, if we think back to the GFC, we saw a similar drop, but that took a number of months, where in this case it was a 3-4 week period that we lost 30% in value if we're looking at the Australian share market. How does that compare looking to previous crashes like the GFC in '87?
Sure. So one thing we look at there is, if you look at the last 20 years in context, and this is using the balanced option returns to do that something like the global financial crisis, which is the most memorable downturn in the last 20 years, you can see how that took a long period of time for even the markets to decline, but it even took over 3 years for the markets to recover back to where they were prior to the downturn. One thing we do look at in the history of markets is they do go up and down over time, that you see smaller downturns every 2 to 3 years. We saw in the commodity crunch, even Brexit vote, trade wars, and even the recent COVID downturn. So you do see these ups and downs over the time, as well as some larger downturns like the global financial crisis every 10 years or so. Basically shows the benefits of having a diversified portfolio that is access to many different assets so that you can weather the storms of the ups and downs without changing your investment position too much.
So looking at the chart there are some ups and downs, and if we look sort of around that 2016 mark, you probably can't see it's not significant now, but it was at the time. We had a bit of a dip when Mr. Trump became president. Get your crystal ball out. What effect on markets do you think now we've got Joe Biden as president-elect?
Sure. So we definitely were closely watching the election, and there was concern even leading into it that what happens if there's contested election. And you look back at probably when you look at Bush Gore back in 2000, how a contested election added a lot of volatility and a sell-off in the markets. What we're seeing now is that with a Democrat president coming in, as Biden is being confirmed as president-elect at the moment, the Democrats do have a very pro-stimulus stance where they're looking to have a very large stimulus package, which will help get out of the downturn, and that will definitely be beneficial to the markets. We also see when we look at over time between a Democrat president and a Republican president, the markets tend to grow and the economy tends to grow in under all types of administrations. So over the long run, looking through these current volatility, we do see returns continue to grow over time.
And I think the key words there, Sam, are the long run. So here we are looking at 20 years and 100,000 going up to 400,000, quadrupling over that period. I suppose it's natural human behaviour for people to have reservations and fears when it's tumbling down. I think it's been said before, whenever markets fall, it's always, we've never seen this before. And I think history does repeat itself. So you mentioned earlier before about AustralianSuper's its size and its ability to buy larger assets with that size and the cash flow. How do our portfolios look then when we construct the investment options like the balance fund for our members?
Sure. So when we do look at the portfolio, the benefit of AustralianSuper is we do have a team of investment professionals that are managing your wealth and looking at investment opportunities across different portfolios to build that. And how we construct the portfolio is we do look at a range of different asset classes, and you can break them down into three main subsets. We have growth assets, mid-risk assets, as well as defensive assets. So growth assets is where you largely get a lot of your long-term returns, and those are things like Australian equities, international equities, as well as private equity. Mid-risk assets sit in the middle of defensive and growth, and they're things like property, infrastructure, and credit, fixed interest, and cash provide stability and income for your portfolio. So bringing them all together truly balances your portfolio out. Where we're positioned now is we do have a very pro-growth stance in the portfolio. So we've upped our weights to Australian equities, international equities, private equity, because we do see that the economic is expected to eventually recover, and that'll provide the most rebound for the portfolio. We also are looking at large-scale infrastructure projects. We've recently invested in Peel Ports, which is a port that run out of the UK, and we feel that those types of projects will allow the portfolio to grow and enhance returns over time. Now, we have seen some headwinds in the property portfolio, as we'll see in the next slide with some of the returns, and that's largely due to the lower foot traffic that we've seen in retail stores in the last few months, especially during the downturn, as well as the rise of e-commerce.
And I suppose, sorry, keep going, Sam. Sorry, keep going.
One aspect we have had a benefit since the downturn. So during economic downturns, we often see a rise in yields, especially in bonds and higher yield bonds. And that's where we've taken the opportunity to increase the credit portfolio to take advantage of those yields. And as the market recovers, we should see the yields compress a bit, which will enhance returns for that sector.
One of the questions I often get asked when I'm out talking to members when we have a downturn is, well, why didn't AustralianSuper just get rid of all its shares and put them into cash? I suppose this slide really shows that when you've got over 50% of the portfolio and significant dollars, it's not the thing you do. You can't do it to start with, but also the long-term view comes back to that previous slide, that there will be ups and downs. You ride the downs to ride the ups, and history shows there's more ups than downs. So how do the individual sectors, you mentioned property as an individual sector, we've got 5 individual sectors that members can invest in. How do they look?
Sure. So one way to look at what's inside the portfolio is even look at our DIY or do-it-yourself investment options, which show a kind of a picture of what's even inside the premixed options. So those are the Australian shares, international shares, property, diversified fixed interest, and cash options. And these show you a point of what's happened in the markets over the last year. And with Australian shares, even though the last year we've seen about 8% decline over 1 year, that's the gray bar, that's the 1 year number. What we've seen there is a large part of Australia that is in some of what we call the old school type companies of banks, as well as industrials and mining companies, which haven't fared as well during the downturn. Where we have seen some success is in our international shares portfolio, where it's increased over 14% this last year. And that's largely because of how it's positioned. You may remember back to the other slide where the broad performance of international shares was around 4%. Where the international shares portfolio is positioned is in very growth and quality type names that have done very well. A lot of technology, consumer discretionary type stocks that have fared very well during, probably prior to the downturn, during the downturn itself, and have recovered well. So international shares is kind of 2 stories. There's a concept of the working from home stocks, companies that have done well, that have digital platforms, versus the stocks that require a vaccine or require a recovery. They tend to be more some of the banks and cyclical type companies that haven't fared as well. And property, as we mentioned, has faced those headwinds with especially in the retail property space, where you have seen some valuations being hindered because of lower rents in that area. What we are looking for there is other areas that are benefiting from the current environment, and also e-commerce, things like industrial warehouses, as well as possibly developmental projects. When we look at diversified fixed interest and cash, low yields are definitely going to hinder those portfolios over the long run. These portfolios are very beneficial for adding stability to a diversified portfolio. However, with very low yields that we're seeing in the markets, and even with the RBA lowering yields recently, we expect cash returns and diversified fixed interest returns to be very low going forward.
And I suppose that's something that's probably a bit contrary to what we've seen in the past, that often cash is the safe place to be, and it has a decent return. Now we're seeing a return that is, in some cases, probably less than inflation. You mentioned before the balance fund, that's one of our investment options, and we allow members investment choice. We do have other what we call premixed options, which you're showing here. They have different asset allocations. What's the theory behind that?
Sure. So when we put it all together, those individual asset classes into the premixed options, these options let you tailor the investment growth and stability that you need in your portfolio to meet your own personal objectives. So the main aspect you are looking for, as you mentioned, is how do we outperform inflation over the long run so we can increase the amount of retirement income we have. So when you look at something like high growth, balanced, socially aware, and index diversified, they tend to have more weighted towards growth assets, which help increase your return over time. However, if you are looking for more stability and you want lower volatility in your portfolio, portfolios like conservative, balanced, and stable will provide that for you, especially during market downturns. The biggest part of that is when we look through is not just the short-term numbers, but how these options have fared over the long run. So the orange bar shows a 10-year number of that these portfolios have performed 9 or 8.5% or more over the long run, which is really what you're looking for as a long-term investor.
So I mean, that they pretty much, looking at the charts there, they fit the purpose. As we move to the right, your volatility reduces, and therefore your expectation of return reduces as well. And as you said, yeah, members can construct the portfolio to suit those. You don't have to have all your eggs in the one basket when it comes to investing. Now, each of these investment options have investment objectives, an objective to achieve a level of return above inflation. We also have an objective at AustralianSuper for these funds to have an objective to be better than the average fund, because it's easy to make money when everyone's making money. We're very proud of our performance numbers.
Yep, definitely. The biggest thing to do with super is to compare. So you want to make sure that the investment option you're in, how that compares to peers and how it compares to the broader market. So when we look at the balanced option and compare that to its benchmark of the median manager, over 10 years, we've outperformed by about 1.5%, and over 20 years, we've outperformed the benchmark by 75 basis points. And even though that doesn't seem like much, 75 basis points, that if you compound that, if you had $100,000 invested, if you compound that over 20 years, you would have $50,000 more in assets for your retirement income. With our performance, our primary goal is to enhance your returns and to be a top decile performer. So to continue to rank in the highest brackets among competitors is very important to the fund. And that's when we have been very successful in that. When you look at how we've done over 5, 10, 15, and 20 years, we've ranked either 1 or 2 in those time periods.
And it's not on the chart here, but if we go right back to when AustralianSuper started back in '85, I think the average annual rate of returns a bit over 9 and a bit %. So this is the long-term growth, the long-term game we play when it comes to investing your super. I suppose now we can open up for questions. If anyone's got any questions about some of the information that Sam's gone through, whether it's about AustralianSuper specifically or broader economics. Whilst we're waiting for some of those questions to come through, I'm going to touch on a couple of things that sort of fall into my bucket more than Sam's around the legislative changes to super. The budget was very super light this year. There's a proposal around a new term the industry is going to get used to called stapling, which means when you get your first job and have your first super fund, that super fund follows you for the rest of your life. Now, you can always change and de-staple and staple to another one. So the idea of that by the government is to stop people creating multiple super funds. I once met someone that had 14 different super funds running because they had 30 odd jobs over 5 years and accumulated super funds like coat hangers nearly. So that's one of the legislative changes. The other one that came in April this year was legislation called Putting Members' Interests First. So this was around insurance and the potential for insurance premiums of a super fund to erode the balance a member might have. So the impact of that has been from the 1st of April, people joining a superannuation fund don't get the automatic level of insurance cover unless they're over the age of 25 and have $6,000 in their super balance. So if we look at this logically, people vary in age, but if you join a super fund from day one, your account balance is zero. So the insurance doesn't kick in, assuming you're over 25, until your account balance gets to 6,000. So what we've been talking to members about is making sure if you do change jobs, you adequately protect yourself, but with the insured benefits maybe in your previous fund and your new fund. The legislation does allow you to turn insurance on from day one, but a survey was done 18 months ago with regards to super, and about a third of the population didn't even know where their super was. So it's probably not a stretch of the imagination to think that people don't realise they've got insured benefits. So just a couple of things to think about there. One of the questions that has come in is what is we touched on it briefly, the impact of early release, Sam, on AustralianSuper?
And I think the biggest aspect we found with managing early release is that we definitely we want to make sure that we have liquidity needs in the portfolio to manage any cash flows that members have, whether it's even pension payments or even switches between options, as well as managing early release. So when we looked at how we manage the portfolio, we did have to increase liquidity a bit, especially during the downturn and for the months thereafter, but we haven't had any adverse impacts in how we manage the portfolio.
Okay. One of the questions come in is one of my favourite questions, and this comes back to your warning, the disclaimer at the front that we can't tell you what you should or shouldn't do. We can tell you what you can and can't do. So we often get this question around what investment options should I invest in? So I might just reword that a bit to say, Sam, what investment options could I invest in?
Sure. So the first part is to really analyze your personal objectives and how you basically how long you have to retirement, or whether you're even in retirement now, and how much income or stability you need in your portfolio. So managing how much return you want, as well as how much stability you have in your portfolio, is an important part of making that investment decision. And then understanding the investment options that are on offer and how that relates to that decision. So with that, it's definitely, we have a lot of resources on our website, different tools to look at the different portfolios. We also encourage you to call our member number to help through that conversation. And there are a variety of advice options as well to help you with your personal situation. It's an important choice, and it's definitely good to have the right information to make that decision.
And I suppose it's matching up your expectation with what happens. I mean, if I've got an expectation that cash is going to earn me 5% for the next 5 years, it's not going to happen. Now, it happened 5-10 years ago. It doesn't mean it's going to happen again. So each of the investment options, as I said before, does have investment objectives, and it's important to match up your objectives. So the reality is always there. Being in the job of education, a downturn in markets often sees people say, well, I didn't realize my money could go backwards. It earned 10% last year and the year before. Why did it earn 10% this year? Because investment markets can be volatile. Another question's come in about the forecasting of the fund to continue to grow. Now, I've been with AustralianSuper for over 20 years. Its growth has been phenomenal over that period. If you think back in 2006, we had about roughly $25 billion of assets, and now 14 years later, we're up to that nearly 190. Do we still expect growth at that rate, or just a more modest level of growth, Sam?
So when we look out, we do projections of the portfolio and basically how member cash flows will come through. And over the next 3 years, the fund will grow to, or actually 3 to 5 years, the fund will grow to possibly $300 billion in assets. Over the next 10 years, that could easily be $500 billion. And the important part of that is the planning within the investment team itself to build out our allocations, especially when you think of what how long it takes to get into unlisted assets. So making sure we have a pipeline that's available to meet those expectations. So we definitely, that's an important part of our planning and building the portfolio, is to look at those projections and how we can meet that from an investment capability standpoint.
Yeah, and thinking about that, when I go back 20 years with AustralianSuper and think of our investment department, then there was like 2 people, and a lot of it was outside, run by third parties. A lot of our portfolio is now managed internally, isn't it, Sam? Which has big cost savings.
Definitely. So currently about 40% of the portfolio across all assets is managed internally. And that's largely, especially in the Australian equity space and international equity space. And what we do there is to look to lower costs. So investment management can be very expensive. So by having experts in-house, we can have some cost savings there, as well as we get some implementation efficiencies as well. Even allocating capital between different assets, managing it internally lets us speed up implementation there. And we do have competitive returns as well. So even the internal managers, we weigh ourselves against peers, and we have governance through our investment committee to make sure that we're meeting our objectives internally as well. So when we look at all those combined, from a cost saving standpoint, we see that we're saving upwards of $200 million a year, which directly benefits members.
Yeah. Another question here. Looks like the fund's doing very well. Thank you for the confidence in that, considering the global pandemic. Now, again, there's a bit of crystal ball gazing here. When is it likely to recover? Now, recover is a fairly broad term, and to what it was like pre-COVID.
Yep. And that's the one challenge we see right now, is that we do see a sharp rebound that's occurring in many areas of the economy now, with manufacturing coming back. Consumer confidence and consumer spending has been a little bit slower to come back. We see higher savings rates, and especially in Australia. So what we do expect is we'll see a sharp recovery of some activity in the near term. However, there will be lingering effects over the next several years, where we have underutilization of capacity in both the manufacturing as well as the labor market. So we can expect that unemployment may still be above pre-COVID levels for a few years to come.
And I suppose whether COVID's got the impact on it or not, but we've seen the usual, they talk about the levers that economists pull of reducing interest rates so people start to invest. We're getting interest rates down to the point where there's not a lot of wriggle room. Does it come now back to potentially government spending and government stimulation to kick the economy if people are still squirreling the money away?
So like basically, there's a couple of topics within that. If you think of, we have governments doing a lot of fiscal stimulus to increase spending. So you see a lot, either higher budget deficits as well as higher government debt, which can weigh on things. And all of that is to help spur the economy, to try to help financial stability as well as to spur growth in the economy, and also spur full employment. We want to get people back to work so that they can live their best lives. With all
Yeah.
that, we see this lower for longer part of interest rates, as for the other part of your question there, that interest rates are expected to be low for an extended period of time to help spur growth, which hinders your income. If you're say a pension investor and you need income, it makes it harder for you there, where it does help benefit growth assets on the other side. So that's where it definitely shows to have that balance in your investment portfolio, because you often don't know what's going to happen with any individual asset class. So investing in a mix of assets will help you going forward.
Yeah, especially in the situation we are now, which I don't think anyone watching, and even in my memory, we've never had interest rates this low, and consequently the ability for a pensioner to rely just on saving earnings has really changed. So again, it comes back to what you're talking about before about making an investment choice and maybe receiving some or getting some financial advice around that. Through AustralianSuper or through your own resources. I think that's wrapped up the questions there, Sam. Just from my point of view, as an education manager at AustralianSuper, I spend my life out and about educating people about super. There is a growing level of engagement in super from the general public. Now, I present in tea rooms, canteens, boardrooms, presentation rooms, even out in a tin shed once out in very northern Victoria in 42 degrees, which was rather uncomfortable. But what I'm saying is we can provide education to employers and staff around these issues. Now, whether it's formal education or just a chat, we're happy to follow that through, and you can get in touch with us through our 1300 number, 1300 300 273. So if you've got questions about super in general, you want some more education around what the economy is doing potentially, or what AustralianSuper or the super industry is doing, please do not hesitate to give us a call. So thanks, Sam, for your time. I think we'll wrap it up there. There's no other questions coming through that what I can see. If you do have questions, you can email them to events@asial.com.au, and I believe this webinar has been recorded, so that's going to be made available down the track. So
Excellent.
on behalf of AustralianSuper, thanks, Sam.
Thank you. And thank you for investing with AustralianSuper.
No worries. And for ASIAL, thank you for giving us this opportunity. And who knows, we may meet again in this sort of format, or we may meet again in person. So thank you.